This episode is presented by Invest Puerto Rico. If you believe your business can go anywhere, Puerto Rico is the place. Hello and welcome back to Equity, a podcast about the business of startups where we unpack the numbers and the nuance behind the headlines. Today is April 19th, 2024. My name is Alex and I'm joined today as always by my dear friends. In one corner, we have Marianne Azevedo, who brought the smallest water bottle I have ever seen in my life to this recording. Marianne, how is your thirst quenched by merely 4 ounces? That's my question.
It's a long story, Alex, but water is water, and we all need to stay hydrated.
Kirsten Korosek, do we need water, or can we just drink a whole lot of Pepsi and call it good?
As a desert dweller, I have to say water is more essential than Pepsi.
Yes, you are in the United States state of Arrakis, I believe it's called.
Yes, let the spice flow.
Let the spice flow. And that's what we call New Mexico in the Northeast because it's roughly as foreign to us as other planets. All right, on the pod today, we have a packed show. In the Deals of the Week column, we're going to talk about Cherub, then Maven, and then Rippling. And then the first theme of the week is what the heck is going on over at Tesla? We haven't covered Tesla as much on the show as we did back in the day because it got to be so big, but so much is going on that impacts the EV world, we just can't say no. And then we're going to wrap up with a section that I'm calling Fintech. It's doing all right. A couple of news items there that we're going to tie together to discuss the state of all things Fintech. But we are going to start with Marianne and a company called Cherub. And Marianne, I think this company kicks ass. Talk to us about it.
Yeah, I was intrigued as well. It's an interesting concept. Cherub is what the co-founders describe as a Raya of angel investing. And I shouldn't necessarily have assumed that everybody would understand what that is. Maybe it's because I read too much celebrity gossip, but Raya, and I hope I'm also pronouncing that right, is basically a dating app for the affluent, the wealthy. Celebrities, for example, are on Raya. Anyway, Cherub is attempting to do a similar thing, but matching up angel investors with entrepreneurs.
Marianne, did you just say that you're an avid consumer of celebrity gossip?
I wouldn't say avid, but it is a vice. I find it entertaining. I admit it. I mean, we write about these topics all day long. So, if I want something mindless, that's what I do.
But you could quit at any time, right? You're not really that into it.
Oh,
okay. So you're not an addict. You're in control. Yeah,
absolutely.
Okay.
No tabloid addiction here.
No.
I have a question, though, related to the actual startup and not celebrity gossip. I know Alex wants to go down that road. So is there a vetting process to ensure that the folks who are on there are like legit angel investors or legit founders? Like, how does the process work? How do you get on?
Yeah, well, that's actually a very good question. So it's a subscription-based product for founders. There's 2 different levels of subscriptions based on what they would get out of it. And then the angels, I am 99% sure, all have to be accredited. But beyond that, I don't know if there's any other vetting. She didn't mention that there was. I don't think there's any other criteria involved there. But what is interesting is that it's very similar to like these dating apps. A founder can look at an investor's profile, an investor can look at a founder's profile, and then they can, express that they're interested. And then the other party can look at theirs and decide whether or not to accept or reject that connection. And that could be like, oh, well, that investor's only writing $10,000 checks. Well, we want someone who can write a bigger check or things like that. Or an angel can be like, this company's way too early stage for me, so I'm not going to bother.
I want to ask about the business model because it's free for investors, but they charge startups to join. So They're charging people money who need money, and people who have money don't have to pay. Is that right?
Yeah. And at first I kind of thought, I would have thought it might be the other way around. But no, it's a $480 a year membership for founders to list their companies in the directory, and they get analytics such as how many people viewed their deck and that sort of thing. Then they have a $950 a year membership. This is where the vetting comes in, a more vetted process to show the company more actively to investors. I talked to 2 founders who claim, one of them said that they already got a $25,000 check just by being featured in Cherub's newsletter and then meeting an investor in real life at an in-person event that Cherub held. And then another founder told me that they were looking for more than just money. They wanted connections, and they felt like they were going to be able to make a lot of connections through the site because they'd already raised like $5 million. They're a YC-backed company and a Series A round led by Felices. And so they were like, we're really more even interested in the networking opportunities that can come out of this. So I agree with you. It almost sounds like counterintuitive that the founders would be paying, but I guess so far the couple that I talked to found value out of it.
Maybe it's just not that much money. And so maybe it's more of like a keep the, what's a polite way of saying riffraff out of the platform. So that way for investors who are in demand, they know that if they show up there, what they'll be shown is going to be at least sufficiently serious as to be able to cough up $500 a year.
Right.
Yeah, to me, it feels like being a member of a club, right? Mm-hmm. So there's that networking social aspect, but backed with the analytics and knowing that the people that you're going to be networking with also are interested in potentially investing and also have connections. So, how much is a social club membership at, your local country club? Probably a lot more. And, not filtered for the people that you want to meet. So it seems like an interesting business model to me. And it sounds like they have a wait list of like 1,500 startups. So there's definitely demand.
I think there is. And part of that may have to do with one of the co-founders, honestly. Jacqueline Johnson, she also founded Create and Cultivate. It's a self-described media company for ambitious women. I think she's fairly well known, especially in the CPG space, which there are a lot of CPG companies featured on Cherub, although it's not exclusively based on consumer. There is a lot of it on there. And Angeline Vong, who was at Open Door for many years, they just seem really smart and have a lot of connections themselves. So I feel like a lot of people are drawn to them too. Like, okay, if they're behind this, I want to know more. So I think that also helps.
Yeah. On the consumer packaged goods front, we actually have some consumer tech investing news from Kirsten to get to.
Yeah. So remember earlier this year when everyone freaked out because Andreessen and Lair said we're pivoting away from investing in consumer tech? Well, Maven Ventures just secured a $60 million fund, their fourth fund, that's going to be focused on consumer tech trends. So it's not going away. Startups, if you're working on consumer tech, there are investors out there. And it's interesting because to me, these are smaller investments, right? So around $1 million. They make about 7 investments a year, or 6 to 8, I guess. And they've made 7 investments from this new fund already. But to me, what's interesting, and Alex and Marianne, curious what your opinion is that it's like not just straight up consumer tech. It's a lot of AI. If you look at some of their recent investments. So it's really marrying the two. How is AI applied to consumer tech? Seems like what they're most interested in here. Would you agree?
Yeah. I mean, they were saying that they want to do things like help build the next game-changing health AI company or a robotics AI consumer business. So I think you're right there. One thing also that very much stood out to me, though, is their record that 16% of the firm's portfolio companies have reached a minimum $500 million exit or valuation. And that's 10 times the industry average. Like, dang, that's pretty good.
Yeah, I wonder if that very positive trend will continue, because there's a saying in the world of publicly traded companies. Alex, I'm sure has heard this. It's like, it's hard to catch a falling knife, right? So it's hard to like time the market. It's also really hard to time that perfect moment when to start investing in the next new thing. And in this world, the next new thing is AI. So the application of AI to consumer tech, to me, man, it's going to be difficult to pick those winners. The good news is that they have lots of folks there who have institutional knowledge and expertise in AI and those applications. So
I think the phrase is, don't try to catch falling knives. With the implication being that if you do, you'll cut yourself and get bloody. So don't try to start buying stuff when it's on its way down. But I think it's actually kind of like the opposite in venture capital in a fun way. Like, you want to be one step ahead of what's going on now. And so when you look at like the recent Andreessen Horowitz funds they just put out as part of their $7.2 billion package, they have like, I think it was $1.25 billion for like AI infra and another $1 billion in there for AI apps. So currently that is like the thing people are putting capital into, but with probably less of a consumer focus. So for Maven, when I first read the story, Kirsten, I did think, I'm like, oh, cool, consumer, something that won't be AI for once. And then I saw the portfolio companies had a similar kind of like, reaction to it. But that said, I've learned a lot about consumer stuff lately. So like Pixar, for example, just announced they've reached like their billionth AI generated image for consumers. And, I think ChatGPT's continued stickiness with consumers shows that if you can nail the zeitgeist, the rewards are very large for the intersection of AI and folks. So I wouldn't want to have the challenge of picking that next thing, because it sounds damned difficult. But if you can, I can also see how you could return a $60 million fund several times over with just one deal.
Yeah, and they have the benefit of going more at an earlier stage. So they're looking at potentially making more investments and sort of hopefully planting their investment seeds in a way that is diversified, even though there's obviously a trend here with the AI theme.
Yeah, before we move on, I think it's important to note that a couple of companies that they had funded, actually they had seeded, were Zoom and Cruise. And actually the founding managing partner, Jim Scheinman, is even credited for coming up with a Zoom name.
So all they do is make car sounds and watch cars go by is apparently what we're doing. No, I mean, Maven's track record is pretty impressive. But I want to throw one more thing in here about this consumer AI thing that just occurred to me. There has been an interesting element of like price anchoring in the AI world. Like I pay OpenAI. How much does ChatGPT Pro cost? Does anyone know how much I'm paying OpenAI? I paid them some amount of money every month because my dad loves it, right? And I think that, the Copilot service from Microsoft for GitHub is $10 a month. It's $30 a month for like Office AI for Microsoft and so forth. So I really do feel like the market is saying, hey, these things will cost money. And if you can get a consumer product that you can charge for on a recurring basis like this, you can have a simply enormous amount of revenue. So maybe like the stuff that we're seeing here is going to bear out better than we would think.
Actually, Alex, ChatGPT right now costs about $20 a month, to answer your question. And by the way, what a nightmare future. Like I already am juggling so many subscriptions on the streaming side. Now I have to juggle all these AI subscriptions as well. How much money am I going to be spending 5 years from now? I don't even want to guess.
This is why I have my spouse is detail oriented and handles our day-to-day accounting. So I don't actually know how many things we're paying for, but she says we're doing fine. So I'll take 5 more. Moving us along, my deal of the week is an upcoming round from a company called Rippling, which you might be familiar with if you're listening. It's in the HR tech space, competes with Gusto and Deal and smaller companies like Remo First that we covered on the show a little bit ago. And it's in the process of raising $870 million. But Marianne, ask me how much of that's primary versus secondary.
How much of that is primary versus secondary, Alex?
What a brilliant question. It's $200 million in primary and $670 million in secondary, which is a pretty imbalanced frickin' round. And I think says 2 things. One, that the company is not burning so much that it is desperate to raise as much money for itself as it could, and that it's not going to go public for a long time because it just cashed out a bunch of its early investors and employees. But it's cool to see kind of a round at this size and valuation, Marianne. I was pretty hyped.
Yeah, I was a little surprised, honestly, because it was just last March that they had raised $500 million right after or during the SVB meltdown. So that's a lot of money in a relatively short amount of time, especially in this market. I haven't talked to Rippling in a little while, so I'm not really up to speed on how the company is doing, but this would probably lead me to believe it's not doing too bad.
No, not at all. The information reported, I think that they closed last year on a run rate or ARR basis of $350 million. So getting to be quite large. There are a couple of other competitors that are at the $500 million ARR mark or higher.
Yeah,
so
Deal.
they're not the biggest. Yeah. But what's blowing my mind is just like, I think Gusto and Deal are at 500 million and above. This one's at 350. I mean, there's a lot of revenue in this space. So the valuations do seem a little high. This deal put the company's value at 13.4 billion, up from 11.25. But that said, you can kind of see why there's optimism about these companies.
For sure. It's a massive space.
It is a massive space. So question is, how does this all shake out? I mean, they've obviously now raised a bunch of money. They're looking to expand. They recently signed a 123,000 square foot lease for a new SF headquarters. Wow, people are moving into commercial space. That's insane in San Francisco, right? Quadrupling its office space. So they're spending money. They're expanding. They're definitely on that growth trajectory. But what does it bode in the long term in terms of going public? Do they need to even go public at this point? Is the marketplace big enough for them to remain privately held, get the revenue, and kind of give a big FU to the public markets? Do they need them?
That is a question that is broader and bigger and deeper than just rippling in its current situation.
I know, we could have a whole show about it.
But I think it's also the right question to ask. I will say, though, that whenever you see this much secondary, the presumption is that it's going to reduce a lot of the pressure that might have been behind the company from its earliest investors to cash out those shares. Because some funds have a 10 or 12 year time frame, and that can get a little bit sticky. Also, some early employees can cash out some, so employees agitate less. So no, they don't need to go public. At some point, if you are venture-backed, yes, you have to find an exit because that is how your backers will profit. But the question I think that I would ask is, does it have to happen in the next 3 years? Probably not. That said, there is an interesting IPO coming up next week. So this week we saw the Ibotta deal, and I have some notes later on about that, so save that for a second. But Rubrik is going public next week. And Rubrik is an interesting company. It does data management and cybersecurity stuff. And it's like really unprofitable. And now, I don't know what the state is of all these companies in the HR tech payroll space, but I presume they're not all profitable. And so if you want to get more of them off the bench and into the public markets, I think if Rubrik does well with its unprofitability, that would say there's enough enthusiasm to allow more to go public, and then maybe some of these will. Not Rippling, but maybe Gusto or Deal might consider it. So I think we'll get an interesting test, Kirsten, next week.
Stay tuned.
Stay tuned indeed. All right, now on the IPO front, as promised, Ibotta priced above range at $88 per share, ahead of its range of $76 to $84. And it opened trading on Thursday at something like $110, $111 per share. So yeah, the IPO wins are winsome. I mean, this is great. I did not expect to see this much enthusiasm. And it's great, not because I own Ibotta stock. I do not. But it's great because I'm hoping it's going to get more companies to list so we can talk about them on the podcast, because we've only had 3 IPOs since last August, and then 2, and then it was like a 12-month dearth. So not enough debuts, but good news there.
I wish our listeners could see the glint in your eyes, Alex, when you talk about IPOs.
Before we move on, I just want to spend 30 seconds to mention, because this just happened, Serve Robotics, which is the sidewalk delivery robot company backed by Uber, kind of spun out of Uber/Postmates, really, also backed by NVIDIA. They debuted today and not looking great right now.
Oh no, what's the ticker symbol?
SERV. So this was a reverse merger, very similar to a SPAC, slightly different details. But yeah, they're down. Granted, we're talking small amount of money here, $3 a share. I think they were hoping to debut at $4. They're down 88 cents, which is 22%. So we'll see what happens, but maybe not so bullish on the sidewalk delivery robot.
That is such a gosh darn letdown, because Serve Robotics is like the absolute cross-section of things that I love. Cute robots, delivered burritos, and sitting on my ass. And self-driving. It's it's everything I love in one package. I wish we could buy individual stocks as Turtleless, because it would be fun to buy some surf and be like, yeah, that'll show the haters. I'm going to use their robots. We don't do that, but I'm disappointed. It's off 21% right now. Damn. Huh.
Yeah. Well, but it's just first day. So let's see what happens over the long term. And they do notably have some big companies backing them, NVIDIA, Uber being the main ones, but they're still small, so let's see if they can manage to scale up.
All right, when we come back, we're going to talk about what is going on at Tesla. But first, my dear friends, a short break. What's next in tech? That's not the right question. It's where. Puerto Rico, more than just a tropical paradise, it's an innovations paradise, where startups and global players coexist in a vast and vibrant ecosystem, where talent runs deep, highly skilled, and bilingual. Plus, the island offers the most competitive tax incentives in the US. If you believe your business can go anywhere, Puerto Rico is the place. Find out more at investpr.org/TechCrunch. And we are back, and I'm so glad that we have Kirsten on the call today, because it has been a week of nonstop Tesla news. Started off with a bang, and there has been many developments since then. Kirsten, why won't Tesla leave us alone and give us back the news cycle?
Because Elon's still in charge.
Let's start on the start of the week. So going back to Monday, rumors are flying that layoffs are coming. They arrive, and the company said that they were 10%, or was it more than 10%?
So there's about 140,000 employees right now, or were under Tesla as of Sunday night, and Monday come layoffs around 10%. That's what we're hearing. An email goes out, but it was a little bit chaotic, as sometimes things are with Tesla. Some people, and we had sources tell us this, and other outlets reported this, that people were badging into one of the facilities and then kind of being flagged and learning that's how they were laid off.
Oh, that's awful.
Yeah. Layoffs have happened in Tesla periodically over the years. It's oftentimes used to resize the company, or the big underlying thing. There's a couple themes here. Some very big high performers were part of those layoffs. At the same time as these layoffs, a couple of high profile people who Elon actually let be out there in the public space, which is a big deal. He typically is the one who is sort of the mouthpiece for the company. Drew Baglino being the primary person that a lot of attention has been put on. And the speculation and theory there, which is backed up by some evidence, is that there has been an underlying kind of fight going on within Tesla over whether to pursue a $25,000 or low cost cheap EV, or this robo-taxi that is supposedly based on the same platform. And in Walter Isaacson's biography that came out last year, it kind of gives details on this sort of fight. So it looks like what's happening is Elon, in classic Elon style, is pivoting, is going all in on robotaxi and realigning the business as a result.
So there was also a recent cut to the price of full self-driving, the software package. And I think people also could use it for free for a month, something like that.
Yeah, that's still going on.
Okay. It seemed like a push by the company to get more people getting out there, getting more data for it. And so to me, thinking about that, does the FSD price cuts and free trials feed more data into the company to support the robotaxi push? Because I can see that kind of making sense.
Well, I mean, there's so many questions I have about the robotaxi. So quite honestly, I think the big thing to remember here is going back to fundamentals of the company. Primarily, they've received, revenue and profits from the making and selling of cars. The price wars that started a year ago, really kind of prompted by them, has absolutely squeezed their profit margins to a point where they were once the envy of the automotive industry, and they have absolutely dropped. As a result of these EV price wars and clear evidence of some softening demand across the industry, even though Tesla is still very much a leader, it is still affecting that company. So they're looking for other financial levers. The other financial lever is FSD, really. So the free trial push to me was absolutely more of, sure, is there a data play in the background? Yeah, but it's also a big time revenue play. The fact that they then went ahead and reduced the price suggests that the take rate on that free trial wasn't maybe what they wanted.
Okay.
But that is a bit speculative. So, again, it's a theory. To answer your question of whether this data will then go and be used for robotaxis, we could maybe assume that, but we're talking about the difference between an ADAS system, because FSD is not self-driving, to a level 4, meaning a human driver is not expected to be in the loop, robotaxi. And where that data is used and how it overlaps is still a big question mark, because they haven't talked about it.
Okay. I'm just going to ask you this very, very simply, because I want to make sure that I'm not totally insane. Is there any company in the world right now that has a level 4 autonomous driving system that can be unleashed on, for example, a whole continent worth of roads?
So no, because we don't have evidence of a company doing that. The closest would be, let's say, Waymo, which is currently operating a level 4 robotaxi in which the human being in the vehicle is not in any way expected to take over. And it is operating commercially in Phoenix, Los Angeles, and San Francisco. So not the whole continent, certainly. And so we call them ODDs, or operational design domains. So that could mean the specific geography. That could also mean no left turns, or never when it rains, or no fog. So, what you're talking about is really level 5, anywhere, all conditions, any road. And that is something that, quite honestly, most folks believe is decades away.
Right.
What we're going to see more is the level 4.
Yes, decades away. I like that.
Marianne, I'm already getting my parade rained on. You don't need to add hail to the mix. Kirsten, so my point with that question, although I do very much appreciate the very succinct and clear answer, was more like, what is Elon thinking that robotaxis are around the corner if level 5, to your point, is so far away? What am I missing in this picture that makes this a possibility versus a pipe dream? Because I want to believe it. I want self-driving. I'm the opposite of Marianne here, but it just seems like a pivot off a cliff versus towards a new future.
As a history lesson, Elon Musk has been talking about a car that can drive itself for years. In an interview I had with him as far back as December of 2015, when I was at Fortune, not at TechCrunch, he said it was 2 years away and promised publicly, either via social media or in press conferences or in interviews, that your Tesla would turn into a robotaxi in which you could then make money off of it. So these have been promises that have been put out there for years. Now, Elon has in the past made promises and then delivered on those. This is one that seems very distant, and I don't really, quite honestly, see how they can do it with the hardware that they have right now. They've eschewed a lot of more of the traditional hardware, such as LiDAR on their vehicles, and they're just going based on cameras. Will the robotaxi be the same? There's also regulatory questions, such as, does it have a steering wheel and pedals? Because that would require special federal exemption under FMVSS, which is an acronym I won't get into here. But basically, it's all the requirements that your car has to have, like an airbag, like a steering wheel. Those are real requirements under federal law. If you build a robotaxi without those things, you need an exemption. So what's this robotaxi going to look like? Like, basically, this announcement to me leaves me with a lot of questions and, quite frankly, huge amounts of risk for the company. I know that there are a lot of people out there who are bullish. I'm sure I will hear from you. You're going to tell me that this is the future and he's betting on the future. And it's true that Elon has incredibly high tolerance for risk, probably more than any human being I've ever encountered. But the question is, I don't know how they turn this into a revenue maker in the near term.
I agree with everything you just said. But let's move on. We have to talk about fintech. Marianne, fintech has been the dirge of the technology symphony for quite some time now, but the plodding pace has gone away, and it does seem like we've reached a new tempo. You might even say it's Allegro.
Yes. Wow. Yeah. This week I covered Ramp's latest raise. It was $150 million Series D extension at a post-money valuation of $7.65 billion. So what is interesting about this is the valuation is actually an increase compared to its last round, even though it's still down from its valuation 2 years ago. But wow, in this environment, that's pretty impressive. Also impressive are the list of investors participating in this round. We had Khosla Ventures and Founders Fund co-leading. We had new backers, Sequoia Capital, Greylock, 8VC, and a long list of other existing backers that also participated in the round.
Is this just everyone who's not an investor in Brex?
I don't know. I didn't analyze to that extent, but yeah, there's a lot. It's also interesting, if I have to, talk about this too, is that Keith Raboy, he actually led the investment into Ramp very, very early on, like when he was at Founders Fund and was on the board. But he left to Khosla a few months ago. And so he obviously helped lead the round for Khosla. Founders Fund, I guess, didn't have hard feelings and still participated and actually co-led the round. So I thought that was a little bit of an interesting backstory.
So is this fintech having a moment, or is this just about Ramp?
That is a good question. I mean, Ramp arguably has really stood out as sort of an outlier. It hasn't had to lay off. It's been notching consistent revenue growth, at least based on what they tell us, continuing to raise capital steadily with a valuation that's, not that far off its peak 2 years ago. So, I don't know. I would say it's definitely probably more reflective of how well Ramp is doing. It claims to have done very well in the first quarter compared to the year before. And that is looking at it, as Eric Gleiman, co-founder, said, at a much larger base. So as Alex and I have talked about in the past, it's harder to grow exponentially the bigger you get, but Ramp seems to keep doing that. One other quick note, though, some would argue that Rippling also falls into the fintech space, so because they got into global payroll. So if you count these two deals, then you could also say this is a little bit more of fintech itself having a moment.
stole the words right out of my mouth. And also, I would say that the other bit of fintech news that we have in the show notes today is about Mercury expanding away from just doing business and startup banking into also consumer banking. And to me, that shows a level of confidence in what they've built. They're willing to expand into consumer. I mean, we have seen Goldman Sachs try this with Marcus and torch a bunch of money and run away. So to me, with the Rippling round, with the Ramp round, and then the kind of bold choice from Mercury, that's the combination of those made me feel like fintech's having a moment. I may certainly be over indexing on 3 data points, but that was the impetus behind that as the title of the section, Kirsten.
Well, at least fintech's having a moment this quarter. Let's just put it that way.
Right. Or at least this week anyway.
Yes.
Because who knows what would happen next week.
I said fintech is having a moment. A moment is by definition an ephemeral amount of time. Harumph.
Anyway, yeah, interesting news about Mercury expanding into personal banking. We'll see how that goes. They just want to say that what they are looking to do is more of a premium thing, not going necessarily after the masses, but more targeting like the founders and investors that already use its B2B product, but on the personal banking side.
Okay, we got to wrap. But Marianne, I have one last question for you about Chime. Have you heard anything from them?
I haven't talked to Chime. They're so quiet. I don't know what's going on at Chime.
It's just weird because they grew so quickly and they don't have to raise money. I don't care about that. But I can't recall seeing news from them, hearing about them. No one's reporting on their numbers.
Very quiet.
They're either doing incredibly well or incredibly not well. It's one of the two. We'll find out in time, I suppose.
Maybe I need to reach out and ask.
Well, let's just start going through everyone that's left the company on LinkedIn and just go down them one by one and get them on the phone. All right, but that is all the time we have for Equity Today. Kirsten Korosek from the Transport Desk, thank you so much for your time. Marianne Azevedo from All Things FinTech and Venture, thank you for your time. Equity, of course, is part of the TechCrunch Podcast Network, and our sister show is Found, focused on all things founders. Equity comes out 3 times a week, Mondays, Wednesdays, and Fridays, except for when we have a special weekend interview. Marianne?
Yes, I have an interview coming out this weekend with Hans Tung. Well, he was with what was formerly called GGV Capital, now called Notable Capital. Really great interview. Please listen up for it. You won't regret it.
Yeah. And also to everyone I offended by calling Notable Capital the most boring name in venture capital, I apologize. Kind of. All right. We're out of here. Bye, everybody.
Bye.
Bye.
Equity is hosted by myself, Alex Wilhelm, and TechCrunch senior reporter, Mary Ann Azevedo. We are produced by Teresa Loconsolo with editing by Kel. Bryce Durbin is our illustrator, and a big thank you to the audience development team and Henry Picavet, who manages TechCrunch audio products. Thank you so much for listening, and we'll talk to you next time.